Welcome back, everyone. Michael here with Offshore Citizen. I posted a video not too long ago about strategies for investment in 2022, and I had one of our viewers, David, comment on it, asking a few questions, clarifying a few points that I thought were worth bringing up here. And this is really about the subject of investing in times of uncertainty, okay? So I think there are certain times where the market is in a bull market, and so you want to do risk-on assets, and it's pretty obvious that's what's going on. There are other times when, the market is tanking or going to tank, and it's pretty obvious. We could look at, for example, if you were in 2008, right? This is a time where if you're paying attention to the indicators, fairly obvious that things were looking bad. And so in that scenario, you're going to use a different strategy, right? But then there are times where you have uncertainty, which I would say that the 2022 market fits into. And in this regard, I want to talk a little bit about the mindset and the strategy behind that and why the recommendations that I had in that video kind of make sense. And so, yeah, let's dive in. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. If you'd like more of these videos, check them out. And if you'd like help with international tax optimization, getting residencies, citizenships, relocating abroad, and taking advantage of all the benefits that go along with that, you can book a call with me, calendly.com/Michael-Rosmer, link in the description below, or send a message through our websites, offshorecitizen.net and offshorecapitalist.com. All right, so here's the basic idea. In some cases, it's pretty obvious that the bias of the market is up, okay? Let's just go back to, say, March 2020, when things kind of had floored and they announced QE infinity and the market was starting to recover, et cetera. This was a good time to risk on. The prices of assets were really low. You had a lot of things that were providing tailwinds. Yeah, there was always still some uncertainty, but there was good vector there. And especially as you came into later in the year, this became more apparent, right? 2021, a bunch of it, I would say, okay, you had gotten pretty high, but you were still in that generally good area. Now, late 2021, up to the present, we say, okay, well, a lot of valuations are really high, right? Property has gone up a lot in many, many markets. You have S&P 500, basically at historic highs. Apple just became the first $3 trillion company, et cetera, et cetera. Now, there's certain sectors and certain companies that are down by a decent amount, and so there's maybe some investing opportunities there, fair enough. On the other hand, bonds and interest rates are at historic lows, so there's not really any yield to be found there. Obviously, if they raise interest rates, this means bonds, the bond value itself is going to go down. And so, not a good environment for a lot of this investing. And so how do we invest in this case? Well, if we knew that things were going to go down, we'd invest a certain way. If we knew they were going to go up, it's going to be a certain way. But when you're kind of later on in a cycle, when prices are already elevated, when they've already pumped in a lot of money, et cetera, it becomes much more unclear what is going to happen. And it's possible, if you look at the 2022 market, you could say, oh, it looks like the market's going to go down and we're going to hit a deep, dark depression. Jeffrey Gundlach, very famously the bond king from Double Line Investment, or Double Line Capital. Great thinker, great investor, was really bearish on things. I just watched a report from Cathie Wood, ARK Invest, she's, much more bullish on things. So you've got some different opinions from people who are looking at, pretty in-depth data, et cetera. And frankly, it could easily go one way or the other. So some people might say, okay, well, I'm uncertain, so I'm going to hold a lot of cash. Well, the problem with holding a lot of cash in an uncertain environment is, what if you're wrong? Okay, so if it turns out that the markets go down, then cash or bonds were a good thing to hold, right? Because the value of your cash relative to the value of assets is going up. Okay, so you can buy back at a discount, great. On the other hand, what if you're wrong? What if it turns out that the market continues to soar for the next several years? I mean, I remember back in the day thinking much more bearishly that markets seemed high in, whatever it was, when Trump got elected, or kind of leading into there. It turned out, that kicked off, another few-year boom. So it was a really bad idea in, let's say, 2016 to be really, saying, hey, listen, the market is high, even though the market had been, basically soaring since the lows in March 2009. It had pretty much steady growth with just a few little blips along the way. And so, you would have missed out on a big run up. So you don't really want to sit in cash just because you think that it could go down. At the same time, what if you decide, okay, great, I'm going to risk on, I'm going to buy all sorts of assets like stocks, right? I'm going to, let's say, buy the S&P 500 or whatever, and then I'm wrong and the market goes down, right? You could easily see a drawdown of, let's say, 30%, right? If you're in crypto, you could see a drawdown of 90% or some big numbers like that. So you have to somehow try and figure out, okay, no matter which way it goes, I'm still going to be okay. And in this sense, this is where I was highly recommending the idea of cash flow. And kind of one of the questions was a little bit about, okay, hang on a minute, but if the assets turns out go down, but but enough that the cash flow from, say, dividends, et cetera, makes up for it, you probably should have had other assets anyway, et cetera. The idea is, sure, you're not necessarily going to catch the best strategy this way, okay? So you're not going to be in a situation where you're likely to pick the highest performing asset. You could obviously, randomly pick and be lucky. Probably not going to happen. So instead, what I want to do in a time of uncertainty is I want to say, all right, let's do a strategy that if it goes this way, I'm okay. If it goes this way, I'm also going to be okay. And to me, the starting basis of this is I want to separate my money between some portion of cash-based, cash-denominated assets. So for example, a bond is denominated in cash, right? So the value of it is not going to go up. Like, you're not going to have the equity or the capital appreciation in the underlying asset. At the same time, I also will not have the downside in the capital value, provided there's no defaults and things like this, right? I want, on the flip side, I want to have part of my money in something that's asset-based because I want to potentially catch the upside, right? So I want to recognize, okay, it's probably good to have some cash-based assets, and it's good to have some like equity-based assets. The difference being that this one can go up, but it can also go down. This one can't go up, but it also can't go down in pure like appreciation terms. Again, defaults and things aside. Now, what's going to happen is I'm not sure of the timing. Okay, so timing is really important. What I always look at is there's two principal types of risk. There's value-based risk and there's timing-based risk. Okay, so if you're in a situation where you're right, but you're really early, that's being wrong. So you can go and look at all sorts of kind of very sky is falling, the system is collapsing, et cetera, type people who have been really negative on things, and maybe the big gold bugs for the last 10 years, who frankly have done really poorly and they've missed out on tremendous appreciation. So if you were the person since, I don't know, 2012 or 2011 or whatever, who was busy pumping gold, like, you're flat to down, whereas the person who was busy buying the S&P 500 is way up. And so who is smarter there, right? Maybe it turns out that at some point in time, great, gold does really well. Well, the truth is you could have sold out of your S&P 500 and bought gold and had much, much more of it in the future environment. So you don't want to be really early, you don't want to be really late, right? Neither of those things is good. But it's really hard to do timing. It's tough to, can I tell you what's going to happen in March? No idea. May, no idea. June, no idea. September, no idea, right? And anyone who tells you that they can, it's pretty much nonsense. So in order to avoid or at least reduce the effects of the timing, I want cash flowing assets, okay? So one of the suggestions that was made in the comments, which I hadn't mentioned in the video, but I thought was a really interesting one, was investing in, for example, mining, Bitcoin mining, this is. So basically you're putting cash in, you have kind of an original asset base, and you're getting some sort of yield that's coming out on a monthly basis. And if you can do that with the right price of electricity and the right price of hardware and things like this, that can turn out pretty decent, right? So you're not reliant on what's the current price of Bitcoin going to be that much, because you're getting a return every month based on this hardware, and you can afford to weather things accordingly. So that's kind of interesting, right? You also have something like dividend-paying stocks. You also have something like cash-flowing real estate. There's a bunch of options, okay? Then on the flip side, you might have things like litigation finance. You might have something like film finance. I mean, any sort of kind of high-interest loan. If you're doing some sort of stablecoin lending or yield farming, et cetera. I'd mentioned arbitrage fund, some of these things. So you have each of these on either side. And these, you're probably going to lose out a little bit on the yield to the upside by taking on some sort of a cash flow type environment. But on the other hand, if that is the case, the third option that I haven't talked about, I've talked about it going up, I've talked about it going down. What if it just goes sideways, right? So if it goes sideways, I'm good. So what you're kind of hoping here is that, all right, if the market goes down, I'm getting cash flow on both portions of my investment, so I'm doing fairly well there. Those hopefully are going to compensate me enough that the downside is not great. And because a portion of my capital is allocated in highly liquid cash-based assets, I can buy at a discount, and that's going to make up for the difference, okay? On the flip side, if things go up, well then at least I was getting cash flow on my cash-based assets, and to the upside, I'm busy able to profit from the asset appreciation over here. If on the other hand it goes sideways, all of my assets are producing cash flow, so I'm still not sitting in a negative situation. So this is why, for example, I tend not to be big on precious metals, on commodities in general, is they're not cash flow producing. So you need to really nail the timing. And if you can nail the timing well, yeah, can you do really well off silver or gold or something else? Yeah, you absolutely can. But it's really hard for most people to get the timing. Whereas if I have something where, by contrast, I buy real estate and the real estate is producing me, I don't know, let's say I can get a 10% yield per year, right? So I'm getting 10% yield. Well, I'm probably also getting, I probably don't have more downside than the commodity does. The commodity probably has at least as much downside as the property does. And on top of that, to the upside, I'm still capitalizing on some of the upside. Maybe I don't get the same level of volatility, but I get some. And if it goes sideways, I have the cash flow. So it's a better risk-weighted asset than the alternative. Now the transaction costs are higher, and I have to worry about holding for longer, and there's a bunch of other complexities, management, etc. So you can consider that. But ultimately, this gives you, it's just a better risk-weighted asset. Like generally, commodities are a really poor risk-weighted asset. Over time, they're not good. In the short run, they can be good, and so it's worthwhile as part of a portfolio for rebalancing and things like that, but not so great. Likewise, I would be really concerned about a lot of cryptocurrencies if you're not earning yield. So I think I mentioned this about how you can stake. You could, for example, get ETH and Ethereum and put it on ETH 2.0, and you could stake it over the next few years. It's a longer time horizon, and maybe you're earning 12% or something in ETH, and you weather some ups and downs, and it works out relatively okay for you. Versus holding Bitcoin, this is probably not the best example because the volatility of Bitcoin probably is lower than the volatility of ETH, but it demonstrates kind of the basic point that Bitcoin won't pay you at all. So you're just subject to whatever the market is going to do. And so hopefully that gives you some sense of what the logic is in these situations and why I say in an uncertain environment, I think this is a good strategy. Not necessarily the best strategy in a down market, not necessarily the best strategy in an up market, probably a really good strategy in a sideways market, but definitely in an uncertain market, arguably the best strategy. So I hope that helps. If you have questions or comments, put them below. If you think I'm full of shit or you have ideas, share them below. Appreciate hearing from you, and I will talk to you in the next video.